Guys, we have an important topic to talk about today, which is rolling options. Rolling options is something that I do all the time. We're gonna be looking at my portfolio in just a second. I'm gonna show you live how I would go about rolling in the money options, out of the money options, adjusting a position to make more money. Rolling options is literally the thing that has saved me so many times. Actually, one time I was trading SPY. It went down a lot. This was a very tough month. It was one of the worst months. I lost $31,000. And guess what? By rolling options, I made all of that back in 30 days. Insane. You can basically fix and adjust any position by rolling options, and you can make all of your money back, whether it's a month, 2 months. Yes, in some cases, an option, a stock will basically move really, really against you, and it may take longer to fix it. But in most cases, it is just a factor of time. So let's jump into my portfolio so I can go over some real examples with you on how I would roll every single option position I have. We're going to talk about covered calls. We're going to be talking about selling puts. We're going to be talking about spreads. We're going to talk about every single position I have in my portfolio right now. So let's pull up this bad boy right here. And let's first of all talk about how I would roll a sell put. So when you sell a put option, the thing is you do not really want to roll it unless it goes really, really into the money and you do not have the capital to actually trade that stock, then you do not need to roll it, okay? In almost all cases, I would never roll a put option, right? So here I have American Airlines. I'm not going to roll it. I have no reason to. Even if it is in the money, like I don't think Snapchat's in the money right now. Let's take a look at Snapchat real quick. I don't think it's in the money, but oh, I was so right about Snapchat, guys. Oh, I was so right. I've been telling all my small accounts to sell a put on Snap. We have 50 sell a put. Pre-market is up 25%. Boom. I didn't even know this. I didn't even prepare for this, all right? Join Discord. You have to. I mean, we're about to print money on this. And this is just another typical week for me. During earnings, I usually hit it pretty hard. I'm pretty proud of this. I wish I bought some call options, but anyways, this is a play that I just put out in the Discord. So it's down 500, but it's about to be good. But anyways, let's just pretend that Snapchat went down. What would I do? Well, I wouldn't really do anything. I would just get assigned Snapchat shares and then I'd be pretty happy and I would just hold the stock because I never get worried about selling puts. The whole point of selling puts is you like the stock to begin with. So I would just sell puts. Okay. So the next strategy is going to be covered calls. Now covered calls is a different story and there's some tax consequences as well to covered calls. Basically I have Amazon, right? I have the 160 covered call right now. If Amazon sells off, I'm going to realize a $21,000 gain. I do not want to realize a $21,000 gain because Uncle Sam's going to come, hey, Henry, let me get that 35% of your income. That's going to be $7,000 in fees and in IRS tax money, right? So I do not want to pay the taxes. So legally, right? I never do anything illegal. Very conservative on this channel. What would I want to do? All right. So instead of selling the shares non-voluntarily, because a covered call, if it's in the money at expiration, you lose the stock and it gets assigned to you, right? You lose it. Someone else wants the shares because it makes sense for them to exercise and take the shares away from you. So what would I do? As I get closer to expiration, which is not that far, okay? Let's take a look at this 160 call option. It's in the money, all right? I am losing. Actually, I'm making money on this call option. Kind of interesting because I got such a good price when I ended up opening this call option to begin with. I got a pretty good price. I'm actually up on this call option, but as I approach 517, my chances of getting exercised increase because it is a very in the money option. So what I would do is I would roll for a debit or I would roll for a credit. All right, let me show you what this looks like. I really need to roll this option because again, if I just do nothing, I will lose the shares and the shares will, I'll just lose them and I'm going to have to realize a tax consequence. So instead I go to roll this position. Now I would roll this position higher. So instead of 517, I would go for a future date. Now in my Discord, I talked about the dog strategy. Okay. One time my students were just asking me, how do you roll properly? How far out in terms of expiration do you go? And since I've been coaching for 4 years now and I've coached over 4,000 successful investors. Not that I lost patience, but I wanted to really make it so simple. I wanted to dumb it down. I wanted to tell people this is so easy. A dog can do it. So I called it the dog strategy. So here's what I did. I roll out from the current expiration by 30 days. So from May 17, it would be about June 21. Okay. So I would do about 30. All right. And I call this a 30, 30, 30, 30, 30, 30. The dog, you say 30 enough times, you give it some food, you say 30, the dog will think 30 means food. Okay? Very simple. Pavlov, right? Psychology. Very simple. If you say 30, it knows food is coming. So same thing with this. 30, 30, 30, 30. Just remember 30, 30, 30, 30, 30. And also remember 5. All right? 5. So let me talk about what 30 and 5 means. These are the two two golden numbers, all right? There's a golden ratio. We got 30, we got 5, all right? I don't know where I'm looking right now, but 30 and 5. All right, so 30 and 5. We moved out by 30. Now we move out by up by 5, all right? We move out and up, out, up, out, up. Very simple. It's like a balloon. You let the balloon go, it moves that. If you go like this, your motion makes the balloon go this way, and the balloon goes up because, you know, air and all that. So the balloon goes up that way, all right? Kind of like a tennis serve. I played tennis 15 years. Out this way and up, okay? So 30 days out and up by 5. So I would go from 160 to 165. Here in this scenario, you will experience a small debit. But the thing is, this is awesome. This is amazing. Why? The total debit is $425. You're paying $425. But guess how much you give yourself? You give yourself $5, which is $5. But here we have 5 contracts. You see, 5 contracts, that's $2,500, okay? You're spending $400 to make $2,500. Also, you can just look at the total net debit. So instead of multiplying it by 5, you can forget about the 5. You can just do 85 cents here. See, the total debit is 85 cents, and you're moving up by $5. You're taking 85 cents, all right? Take 85 cents out of your pocket, put it on the table, and I'm gonna give you a $5 bill. How about that? All you have to do is wait 30 days. $5, 30 days. How much do you have to pay for it? 85 cents. That is the way that I roll up for a debit. You can also roll up for a credit. Let's say you don't want to pay anything at all. I'm cool waiting more time. Cool. Instead of 30 days, you can go for a little bit longer. In this case, 84 days. All right. So now check this out. What you would do, you can still move up by $5, except now you get $5 on the table, but then you also get paid 75 cents also. So essentially here you get paid 75 cents and you move up by $5. So you make $5.75 and the net change to you is 63 days. This is how I roll up. This is the genius, no-brainer way to make money trading options. You keep doing covered calls and you keep rolling up indefinitely. You can roll up as long as you live and never pay taxes legally. All you have to do, well, you will pay taxes, by the way, on the money that you make from the covered call. You just don't pay taxes on the stock that you own because you never sell it. There's no taxable event on the stock itself. So what happens is you can keep making money on the covered calls. That's taxable, right? I'm not a tax advisor or even a financial advisor. I'm just multimillionaire teaching you advice, and I love what I do and I don't need the money. I make more money per month than I can spend. I just love doing this. Like, I love it. I want you to get on the same level. I want to show you how to become financially free. I do have a Discord community. I do charge money for it, but really it's just to pay my team. I have a big team because I want to give the best option trading coaching academy in the whole world. And I think it is the best. Coach 4,000 people. I've had the best results. I've really had some of the most successful students that create passive income that can quit their job. So yes, I do make some money, but I do it because I love it. I moved from 160 to 165 here. I think this is really the no-brainer way of doing it. Okay. So let me just show you another position because we talked about selling puts. We talked about covered calls. You may be wondering to yourself, well, where's the spreads at? How do you roll spreads? Okay, well, I will say that rolling spreads is a lot more difficult. First of all, the Robinhood platform does not allow you to roll spreads in one transaction. It doesn't have a roll button. So if I were to click my profitable position of Amazon here, you will not see that I can roll anything. There is no option here to roll, but it's not that much harder. What you want to do instead is, this position is going well, but let's say it wasn't going well. Let's say Amazon was in the money here. What you do is you just simply close it. All right, so I have 10 contracts. You would put 10 and you would close it, all right? You would pay $9.30. Then what you would want to do is you would just open up another call credit spread. You would just go and sell another call credit spread. And instead of 190, 195, you can sell something a bit higher. You can sell 200, 205, 205, 210. You can still follow the dog strategy, which is you can go up by 30 days. You can also go out by 60 days or 90 days. Rolling is the most effective when you go out in terms of time and distance. Time and distance. Very simple. It's like basic physics. Okay. You want to give yourself more time. The more time you give yourself, the more money you will collect. The more distance you go, the less money you will collect, because making a big change is harder than making a small change. This is true in all areas of life. Okay. More time, the better you'll make. But the more distance, the harder it becomes. So go for something as simple as a dog strategy, which is 30 days, 5. Go 60 days, 5. So that's a call credit spread. The put credit spread works the same way. A put credit spread. So I have 2 profitable call credit spreads. I don't have any current put credit spreads in this portfolio, but imagine we had a put credit spread. You would just move that down. So if you had a put credit spread that was 90, 85, you would go down to 75, 70, for example. Or you can go from, let's say it was 90, 85, you can go down to 85, 80. 80, 75. You can do that very, very easily. But again, with a put credit spread, it's a little bit harder. Reason it's harder is because you just have to fully close out the position and open up a new one. All right, so let's talk about the poor man's covered call. This is a strategy that I use from time to time as well. And it's just the same thing as a covered call. You can move it up or down by 5. You can also move it up or down by 3. Okay, so rolling is very simple. I'm trying to come up with more examples, but I have many profitable positions. Let's go, and this is part of a poor man's covered call. Let's actually go to Target, because Target is a stock that I've had for some time. And it's a very similar case that I was right on the stock. I'm up a lot of money on the stock itself. So if I go to Target right here, you will see that I'm up on the stock $29,000 and I do not want to lose it. Okay, I don't want to lose the shares. This is actually true for many of you guys. Many of you guys have a stock that you really like. You've sold a covered call and you don't want to lose the shares. So what you do again is I have a 140 call and the stock's at 164. So what I can do is I can move the 140 call up. So also, just so you know, you can move it up a lot more than 5. So if I go to roll this position, I can show you what it's going to look like if I were to roll it up by 10. This would be expensive. And this option already expires in August. So it's already pretty far out in terms of date. But let's say I increased it by a lot. So I went from August to November. I went from 140 to 150. Even in this case scenario, even though I added a lot of time, 91 days, there is still a debit of $4.50. Okay, this is a debit roll. However, you will notice that I'm moving from 140 to 150. So this is a $10 improvement in my cost basis. I'm getting an extra $10 and I'm paying $4.50. So ask yourself, are you willing to wait 90 days, 91 days to turn $4.50 to $10? And the answer for me is yes. So I will continuously do strategies just like this by rolling up every single time as long as it makes sense to me. A debit is fine as long as you're getting a really good reward to risk ratio. If you want me to do a part 2 on rolling and you have some specific questions, leave a comment down below and I will make sure to make a part 2 for you.